Income Tax 2020, Practice Problem 1, Presentation 20, Itemized Deductions, Taxes You Pay. Come in, relax with Income Tax 2020. Here we are in our Lacerte tax software. You don't need the Lacerte tax software to follow along, although I do believe they have a 30-day free trial. So if you can get access to a promo version or a demo version of it or any other tax software, it could be a good tool to practice with. We're going to be continuing on here with our comprehensive practice problem number 1. In the prior section or a prior section, we enter the income line items to get down to the taxable income here. Then we entered the above the line deductions, which are the adjustments to income. Now we're focusing in on the itemized deductions, those on Schedule A, those only being taken if they are greater than the standard deduction, which in our case for the married filing joint tax filer will be the $24,800. So you want to keep these standard deductions in mind. If it was a single taxpayer, it would only be the $12,400 that they have to clear before they can take the itemized deductions. That's still a pretty heavy threshold in comparison to what it was, prior to a couple years ago. So a lot more people are taking the standard deduction these days. But in any case, we're going to go back to the Schedule A now. Last time we took a look at the medical and dental. We're going to just move on down to the next line item, that being the taxes you paid, noting that in practice, oftentimes you would be looking at the next line item, that being the mortgage interest. That is usually the one that's going to be kicking people over, that in conjunction with or along with the state income tax and the taxes that you pay with regards to the property, your home typically, that being the property taxes. But we're going to be focusing in on the property taxes at this point, and then we'll get to the mortgage interest next time just to see how they would add up, and then we won't get over the threshold until the interest that we pay, which will be next time. Now, when you look at the taxes that you're paying, it can be a little bit confusing with the taxes because you got different taxes that will be included, and you're actually doing the taxes for the federal income tax now, so it gets confusing as to which taxes are deductible. Obviously, the federal income tax is not deductible for the federal tax calculation that we're making. Otherwise, we would have a circle reference of some kind. Some types of state taxes then might be deductible, and local taxes. So if we have the state income tax, that's the thing that's being calculated by the system right now. If you have a state income tax, then that might be something that would be calculated and helped to calculate by the system, but it would be in the amounts that would be paid. And then you also have then the sales tax. If you're in a state with a sales tax, then it might help you to calculate kind of like that standard sales tax rate. And then the other big tax that you might have included will typically be the property tax. Now, the property tax could be in conjunction with the payments that people are making on the mortgage, meaning you might have some documentation from basically the mortgage company, which will tell you what the payments were made for the property taxes as well. So you might get it in the same kind of package that you might get the 1098 with, or it might be paid separately. So you need to then ask. And the thing that usually will trigger people's mind as to whether or not they should be asking about property taxes on the home is obviously in the prior year, did they itemize? And do they have a mortgage interest? So if you see something that has mortgage interest, a 1098, then you're going to say, okay, now they have interest, they have a loan, that means they have a home. If they have a home, that means they're going to be paying property taxes on it. Then you want to ask for the property taxes that were paid. When considering the property taxes, it typically is when they were paid. So the property tax bills may not line up in the same year. They might be, every 6 months or something, 2 times a year or something like that. But you're looking for when the actual property taxes were paid. Generally, the general rule is a general cash basis rule here. So let's go back on over to the taxes. That's the main one we're going to enter. Now, where would we get this information? Again, you might have it on with the 1098s because it might be paid through the same mortgage brokers, but it might be not. And so you're going to get it from the organizers that you sent out, or they're going to have to provide you that information, meaning the organizers are something that you will often send out to the taxpayer, and hopefully they fill it out. And one of the questions will be related to the property taxes in the organizer. And if they don't, then you're going to have to ask them about it, put a note in it, and make sure that you pick up the property taxes if they own the home. So we're going to go then to the taxes. We're going to enter the main taxes here, that being the property taxes for the use of the residence. So we got the principal residence property taxes, and we're going to say that it was $6,500 for the year. $6,500 for the year. Now you may have some other taxes like part of the DMV tax, and some might be something deductible, but that's usually going to be less. And we'll talk more about auto expenses and whatnot when we get to the Schedule C. We might get into the auto expenses there, but just realize you might have some other small taxes like the portion of the DMV tax or fee that's a tax and whatnot. I'm going to go back on over. The big two, of course, here then being the property taxes and then the state tax calculation. So the state tax calculation here would be the amount we paid, which at this point is less than the rate that would be calculated for the sales tax. Therefore, the system is taking the higher of the two, which is going to be the sales tax item. Now, that might change later. We might have an adjustment to that when we do the Schedule C type of income as well. So that means at this point in time, we've got the $869 that's being calculated by the system as the sales tax, because that's higher than the income tax that we pay to the state that would be deductible for federal tax purposes. And then we had the $6,500 for the real estate taxes, bringing our state taxes up to that $7,369. So we're still under the threshold. If I scroll down, we're at the $12,962. And also note that if we end up itemizing here the state taxes that we got a refund for last time, then we got to question whether or not that's going to be included in income. So if we do deduct the state taxes, in other words, if this was the state income tax and we overpaid the income tax, then if we got a refund in the following year, we'd have to count it as income at that point. So we might talk a little bit more about that in the future. But as of now, we got the $5,093 for the medical and dental, the $7,369 for the taxes, that being the sales tax, the state tax, and the property tax. We've got the $500 for the gifts to charity, giving us that $12,962. That then pulls over to the first page of the 1040. However, it's less than the standard deduction still at the $24,800, and therefore we're taking the standard deduction still at the $24,800. So no change to the first page of the 1040 as of yet.